The VXX, they buy like two month vol and sell it when it gets to 1 month vol and buy 2 month again.
Exactly.
Roughly.
It's a constant roll up an upward sloping curve, and so it appears to be the world's perfect shorting instrument.
Yeah, but only in the short run, right? Because if you look at some friend of mine was actually emailing me about this, but I think if you look in the long run, the capital left in a fund like that has dropped like crazy. In fact, I think they do reverse splits. Is it possible?
They constantly reverse split. So they just did a 1 for 4 reverse split a couple of days ago. It's gone from, I want to say 9,000 to its current level of around 22. But because of that performance, you're actually seeing an extraordinary amount of interest in shorting it, and the growth is on the inverse of these now. Right?
Oh, so shorting
vol.
the long vol.
Shorting the long vol component, right? Effectively capturing, so the larger trades that are coming in particular, money has flowed into SVXY, which is an outright long expression of the inverse, basically, of the VIX, right? So it loses money if volatility spikes, and it loses money if the volatility surface is inverted. But it makes money if the volatility surface is steep, or if the VIX falls over a day or the course of time, right? And these are extraordinarily crowded products at this point. I can't think of anything one of the reasons I focus on the equity side is because that is where the innovation is largely occurred. I can't think of anything that's the equivalent in the fixed income side. Is there?
No, although some of this stuff. I think not a lot of, but some of the stuff in a sort of metaphorical way reminds me of CDS, in the sense that before people invented CDS, if you wanted to go long credit, it was incredibly difficult. You had to be smart because you had to buy corporate bonds and hedge out the treasury risk by going short the right amount of treasuries and continually adjust. And then once people created CDS, it became easy for amateurs to just trade credit.
Yep.
And I think that's happened to some extent with volatility, in that once people figured out how variance swaps work, and then once people created the VIX, and once people created futures on the VIX, now, as you were saying, you can be an amateur and go short volatility without having to do any complicated delta hedging or buying options and running Black-Scholes. So it's made it easy for people to do these things, and maybe there's a bit of a bubble in this in the way there was in CDS too, because it became very easy to transact.